You're listening to Uranium Spotlight Podcast, sponsored by PurePoint Uranium Group. If you're following this market closely, you'll want to explore Behind the Curve, understanding when and how the uranium market turns, a new white paper that shows investors how to spot the cues that come before uranium prices move. And now, your host, Chris Frostad.
It's December 2nd, 2025, and this week on Uranium Spotlight, we look at a steady spot market holding firm through thin holiday trading, Niger's high-risk uranium shipment, India's long-term supply move, and NexGen reports its highest-grade intercept ever at PCE. The uranium spot price closed last week at $75.85 a pound after opening at $75.90, essentially flat through a shortened U.S. holiday week. Trading was thin but steady, with 7 spot deals completed, all centered on prompt 0 to 3 month delivery. Pricing held firm across all major delivery points, where bids and offers showed only minor day-to-day adjustments and ultimately ended the week unchanged. November wrapped up with strong underlying activity, totaling more than 40 spot transactions and over 4 million pounds of material. Nearly all of that volume was prompt delivery U308, reflecting buyers' continued preference for securing near-term supply rather than pushing demand into later delivery windows. Year-to-date spot activity continues to track above historical norms, supported by both financial entities and utilities managing uncovered positions. The term market remained subdued, with utilities largely in evaluation mode. Several ongoing tenders spanning reload requirements from 2026 through mid-2030s continued to progress, while other buyers were preparing additional long-term requests. The broader pattern shows utilities steadily moving towards multi-year coverage, but without a surge of new awards last week. Even with light participation, the spot price once again demonstrated notable resilience. A firm base near the mid-70s continues to hold despite muted trading, suggesting limited willingness from sellers to discount material and very little excess supply in the near term. For investors, the quiet takeaway is that pricing stability in a quiet week highlights how tight the prompt market remains, even when both utilities and funds ease off the throttle. The steady firmness we're seeing now is one of the cues discussed in Behind the Curve, the white paper that shows investors how to recognize when uranium's real move is about to start. Get it now at uraniumspotlight.com. Niger advanced its plan last week to sell uranium seized from Iran's Somair operation, marking one of the most significant unilateral moves by the country's military government since taking power in 2023. The shipment consists of roughly 2.3 million pounds of uranium, material that was legally disputed and previously protected under an injunction issued by the World Bank's International Arbitration Court, which explicitly barred Niger from selling or transferring it. Despite that ruling, a convoy of more than 50 trucks departed Arlet, moving the uranium overland towards a coastal port in Burkina Faso before it is reportedly bound for Russia. This route travels through regions known for insurgent activity, highlighting the extraordinary lengths the junta is willing to go to convert the material into cash. The Prime Minister reinforced this stance during a televised address, insisting that Niger's control over its mineral resources is absolute and non-negotiable. This escalation follows a series of government interventions in the mining sector, including the cancellation of Iran's license at Imoran last year and the seizure of Somair shortly afterwards. With international aid sharply reduced since the coup, selling the seized uranium may be one of the regime's few remaining avenues for immediate revenue. French intelligence officials have suggested that the cash-strapped government may be relying on Russian financial support, with Russia taking the uranium despite already having long-term supply commitments secured through Kazakhstan. The implications extend far beyond the immediate transaction. If Niger is willing to breach an international ruling to move physical uranium, it raises real questions about the reliability of supply from politically unstable jurisdictions. It also increases the risk of future disruptions, sanctions, and legal challenges that could influence global trade flows in ways that are difficult to unwind. For investors, this matters because it shows how geopolitical pressures can shift material unexpectedly out of established supply channels, reducing predictability and increasing the strategic value of stable, transparent jurisdictions. India and Canada moved closer last week to finalizing a 10-year uranium supply agreement that would see Cameco deliver approximately $2.8 billion worth of natural uranium concentrate into India's reactor fleet. Based on today's long-term pricing, the proposed contract equates to 28 million pounds of U3O8, representing one of India's most substantial fuel commitments to date. The breakthrough occurred during a meeting between Prime Ministers Modi and Mark Carney ahead of the G20 summit in Johannesburg, signaling a renewed warmth in diplomatic relations after a period of tension 2 years ago. Both leaders framed the deal as foundational to a broader trade expansion strategy with aspirations to double bilateral trade to $50 billion by 2050. The supply arrangement comes at a pivotal time for India's energy strategy. The country aims to reach 100 gigawatts of nuclear capacity by 2047, an ambition equivalent to building 100 AP1000 scale reactors. India is also unique in its position within the global fuel landscape. It currently hosts Rosatom-built reactors while simultaneously courting long-term supply from Canada, effectively navigating between competing geopolitical groupings in the uranium trade. But the scale of its future demand is immense. India's build-out is accelerating at the same time China is expanding its own fleet even more aggressively. Meanwhile, Western utilities are increasing term contracting as supply growth struggles to keep pace. Existing production from Canada is already heavily committed to U.S. and European markets, leaving limited room for additional long-term volumes without new greenfield mines coming online. This agreement therefore represents more than a simple bilateral win. It signals that India is moving early to secure supply while it is still available, anticipating tighter conditions as global reactor fleets expand and inventories continue to be drawn down. Its strategy also reinforces the growing bifurcation of the uranium market, where origin requirements, geopolitics, and long-term security of supply are beginning to shape trade flows as much as price. For investors, the message is clear. The largest future buyers are locking in long-term supply now, well ahead of when they need it, which compresses availability and elevates the strategic value of reliable, well-governed production centers. NexGen reported its strongest assay results to date from Patterson Corridor East, with hole RK25256 delivering a standout intercept of 5.5 meters at 21.4% U3O8 between 590 and 595.5 meters. The interval includes 2.5 meters at 46.1% and a half meter at an exceptional 74.8%. An adjacent zone added 1.5 meters at 5.28%. Importantly, this mineralization sits 119 meters down dip of RK25232 and a further 51 meters below the recently reported RK25254, extending the intercepted high-grade structure to at least 215 meters of dip extent. Management emphasized that these grades place PCE in rare company among the world's highest-grade basement-hosted uranium systems, drawing direct parallels to Arrow just 3.5 kilometers to the west. With more than 190,000 hectares under control across 140 kilometers of prospective corridors in the Southwest Basin, NexGen sees PCE as a major addition to its long-term development pipeline. For investors, the key takeaway is this. Results of this tenor materially strengthen the discovery case at PCE and expand the potential scale of the broader Rook I system, supporting the possibility of multiple future development centers rather than a single flagship asset.
Before we wrap up, if you haven't yet read Behind the Curve, Understanding When and How the Uranium Market Turns, it's worth your time. It explains the real signals that reveal when uranium prices are about to move, long before the headlines catch up. Order your Behind the Curve white paper at www.uraniumspotlight.com. You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by PurePoint Uranium Group. While our passion for this sector is undeniable, remember that nothing discussed here should be taken as investment advice. Our goal is to provide a clear and balanced view of the factors influencing uranium prices. Join us again next Tuesday for Uranium Spotlight.